Before we begin, it's my pleasure to introduce our speaker for today, David Ng. With years of experience in the derivatives industry, David is a seasoned expert in this field. Previously, he served as the head of marketing in Philip Futures, where he led the marketing team in driving growth and development of the derivative industry. Currently, David is a full-time proprietary trader with Iceberg X Sdn Bhd, which is a local proprietary trading firm. He brings a wealth of knowledge and expertise to our session today, and we are thrilled to have him share his insight with us today. So without further ado, I am delighted to hand over the presentation to David. David, there you go.
Yeah. So just before I start, just like to extend my gratitude towards Excellent as well as Bursa Malaysia for organizing this session tonight. And obviously the audience for joining us. Hopefully you guys had your nice dinner. And hopefully the next hour or so, I'm able to share with you some of my strategy whenever I trade the local market. And importantly, I think if you are using technical strategy, I believe there's a lot of various methods that's available outside, that you can use, that you can obviously employ whenever you trade the Malaysia market. But nevertheless, I think if you have already an existing set of strategy that's giving you a good performance, I think you can continue to do so. And keep in mind, I think markets is ever dynamic, ever changing. Whatever strategy that you use for a period of time doesn't always mean that it will work the next period or so. So as a trader, being in this market for a period of time, I finally understand and acknowledge that in ever changing market condition, it is very vital for us to make sure that we have that flexibility and adaptability. Whenever market changes, we have to also fine-tune our strategy in that sense. So hopefully, for tonight's session, I'm able to share with you, or rather you're able to get back certain things, especially when it comes to using candlesticks, Japanese candlesticks, or in fact Heiken Ashi, which is one part of Japanese candlesticks, as a tool for you to use whenever you are looking at the Malaysia futures market. So just before I start, as usual, risk disclaimer. I think anything I mentioned here is purely for educational purpose. Some examples shown on strategies are purely based on my opinion. It doesn't reflect any opinion by the exchange or even by the organizers. So really, I think at the end of the day, if you are new to the futures market and you intend to dabble in the futures market, make sure you consult a licensed representative before you start trading in your futures market. And like any other education, I think it's important when it comes to trading. It's a very to a certain extent it requires a lot of effort. But I think importantly is that we must have the specific knowledge and the foundation for us to kickstart our journey. So I believe you have listened to some of the previous webinars. And hopefully you're able to gain some insights and some of the key ideas as to how you can start your journey when it comes to futures trading. So I think in tonight's agenda, we're probably going to touch on, as a topic mentioned, we're going to talk about mainly on Heiken Ashi, which is one technical tool that a lot of traders use. Just to also disclaim here is that there's two major types of trading methods is outside. One is what we call a trend trading, which means that if the market is uptrend, you just ride along with the uptrend market, or if it's a downtrend market, you ride with the downtrend market. Or there's another type of traders or category of trading methods, which is mean reverting or sideways, which is very useful in a sideways market. So I think Heiken Ashi in most instances is actually pretty applicable for a market which is showing you trend. So in that sense, I'm showing you examples of a trend trading strategy. So example, if you are looking at a market as on an uptrend basis, so you should be finding opportunities for you to long the market. Vice versa, if you're looking at a market where it's a clear downtrend, then you should be looking opportunities for you to short the market. So Heiken Ashi is very applicable for trend trading instead of mean reverting strategy or sideways, which is very useful in the sideways market. So we're going to talk a bit on how Heiken Ashi is being calculated. Not too bothered by the complex calculation, but rather the application of it. I think importantly, because as the advance of technology, if you compare those days when we don't have technology at our forehand, obviously understanding the method to calculate Heiken Ashi is important. But nowadays, I think with just a click of a button, you can obviously change your chart layout from a Japanese candlesticks to Heiken Ashi very easily. And I do believe that a lot of chart providers outside, they do incorporate Heiken Ashi as part of their tools as well. So I think with the advent of technology, obviously Heiken Ashi is being made widely available to almost all traders around the world. Now, I think if you just talk about Heiken Ashi itself, when I trade the actual market, I just don't incorporate Heiken Ashi as one part tool as well. I do incorporate other tools as well, other trend indicators too as well. So I'm just going to be touching on moving averages and also ADX, average directional indicator. And also obviously talking about average true range as an indicator for us to use whenever you are looking to manage your risk. So now I think I obviously I said this many times in the previous seminars or not. When it comes to trading strategy, I think importantly, everybody is very bothered on making sure that they hit a certain target profit, they hit a certain profitable rate. I think that's important, but what is more important is that we have to measure our risk. There's no point taking a position where your risk is way too much, or you are exposed yourself to too much of a risk. So I always advise this: if you are new to trading, when it comes to designing your trading strategy, make sure in every trades that you have or set up, make sure you have a risk management in place, or rather you have a stop loss in place. Because without that, with market that's so volatile and erratic this time around, I think you can easily get yourself in a hot water, especially when market turns in a quite aggressive manner. So I think that's important. And I wish to find out to the audience today that if you're someone new, you're considering to consider a journey in trading futures, I think it's important whenever you're designing your trading plan to incorporate stop loss as a way for you to manage your risk. There's no point, just focusing on aiming a certain profit level without managing your risk. So I think just like to start by showing you, if you're new to trading, you're new to the futures market or new to the trading perspective, I think there is a lot of type of trading styles out there. Again, I think all these are pretty much very individualistic. Trading itself is actually quite individual. So I think when it comes to trading style, it all depends on your risk profile. If you're someone that prefers lower risk, then obviously you're going to be involved more into day trading or scalping. Now, these four styles are not only the definitive style of a majority of all traders around the world, but it comprises almost everyone that trades the market. Now, scalping in the sense that you just be someone that is combining, you're going in and out of the market in an instance. So if you just take if you are happy with one tick profit, then you'll be in and out of the market quite fast. The problem is that in scalping itself, in a very efficient market, it can be very challenging in a sense that because with the advancement of technology, a lot of traders nowadays are also engaging into algorithmic or even sophisticated system whereby the speed of execution is very fast. If you just look at overseas, sometimes the market execution speed is you're talking about in seconds or even in fact in milliseconds or even down to nanoseconds. That's pretty very fast. So scalping in a sense that gone are those days whereby you can easily scalp a tick or two ticks. I think with the advancement of technology, a lot of these algorithmic traders or technical traders, automated traders are pretty much involved in this space. So scalping is going to get a bit difficult, if you're still doing it manually. So that is something that you have to consider, especially you are new to the trading industry. Now, second, I think day trading. Day trading is more of traders who always maintain positions at the start of the day and always close out their positions at the end of the market. Now, day trading, in a way, you minimize your risk, especially if you are talking about not having or not extending your position over the weekend, because anything can happen over the weekend. News, if you look at it, I think economic news or flash of events tends to happen over a long weekend break. So day trading, in the sense that you want to minimize that risk, you don't want to take your position exposed over the non-trading days. So therefore, you always tend to close out your position at the end of the trading day. So day trading, in a sense that, again, you are also a bit more short term, in the sense that you're looking at shorter time frame. You're not looking on a daily time frame. You're looking way lower than the daily time frame. So in a sense that, if you're someone that don't like to have the hassle of or the stress that comes with the nature of trading, especially when you enjoy your long weekend break, I think day trading is more suitable. So these are all different styles. Now, the next one will be swing trading. Swing trading are more to what I say trend traders. Technically, they are looking at certain patterns, certain trend in the market. So, if, for example, if the market has been trading on a sideways for a pretty long time, there's always a clear resistance and support level. And once that market breach that resistance or breach that support, that's where trend traders will come in, and that's where they start to see, oh, there's actually a trend in place, there's momentum in price. Therefore, they jump into it. So in a sense, I think swing trading are more for traders that's a bit looking more into a medium-term picture. So they tend to hold positions longer than a day. So if the trend is there, the trend is in place, they'll stick with the trend until the trend exhausts itself. So I think going through certain slides later, I will share with you which are the pinpoint, especially when you're riding a trend. There are always critical areas where we can witness in a particular trend where it starts to show weakness, and that's where, if you're a trend trader, you should be getting out of the market. So swing trading are more to a trend trader. That means they are looking at, they are observing the trend in the market, and if the trend is in place and there's momentum in the trend, they probably will ride through with the trend. Now, position trader, now this is what we call having a bit more longer term. In fact, I think in terms of period that they are looking at for this type of traders, they are looking at the longest period as compared to other style of trading. Now, position trader are usually people who have a view, they have an opinion of the market. Now I wouldn't say that these type of traders are very difficult for them to achieve certain desirable profits in the market. They still have some successful position traders, but I can tell you, if you are new to the venture of trading, many of us will start off not being a position trader, because position trader requires, and in certain ways, a fair amount of capital. Again, futures is a margin product, whereby it's a leverage product. So keep in mind, if you have a product where you're highly leveraged, if you are in the right trend of market, you're fine. But what happens if the market go against you? Position trader, they tend not to cut their position, despite the market showing you signs that the trend is changing, market is different now. But position trader, because of their opinion that they form in their judgment whenever they place or they execute their orders, they tend to stick to their view, or they tend to stick to their position. So because of that, I think when market do start to take a turn, or do start to change a trend, that's where they tend to be slower to react. So I would say, I think position traders usually are more seasoned, in a sense that they have probably experienced the ups and downs in a particular product or a market for a period of time, and I think it's more suitable for traders who have a bit more capital, in a way they can buffer the fluctuation in the short term, especially when you talk about a particular market, a volatile market. So position traders are very more talking about traders who have a bit more experience in the market, especially in the particular product they have been trading for a period of time. Now, I'm just going to share with you in today's webinar on a very simple trading setup that we can use. There's always a notion, trading strategy must be complex. Now, there's always a debate on that, and I can honestly tell you that the more complicated your system strategy is, or your trading strategy is, it's going to complicate you more. You must understand that when you face markets, and you being as a trader, when you face the market at any instances, it's always a decision you have to make. Whether it's buy or sell, it's an instant decision. So when you have complicated strategies, or rather you have a lot of decision rules where you have to decide, it will really slow you down, especially when you talk about market that is moving very fast. On one time frame, you're looking at the market is going up, on the other time frame the market is coming down. So you need to make constant decision, and for you to make that kind of constant decision, you need to have simple strategy. Obviously there is no 100% or a strategy that give you 100% hit rate. Obviously, there is certain strategy will give you a higher percentage, certain strategy may give you a low percentage. So that's where trading, or rather trader itself, the journey of a trader, it requires you to always fine tune your strategy in line with the market circumstances. Again, market will never behave the market will never maintain its behavior like what it behaved yesterday. If the market is behaving this way, tomorrow the market will behave differently. So that's how the market is in natural state. So that's where, as a trader, we always have to be very flexible in our tools. And therefore, I think when it comes to planning a certain technical strategy, we have to also be flexible in our approach. Again, we try to keep it simple. We don't complicate things. Always make sure that, whether you identify yourself, whether you're a trend trader or you prefer a style whereby you're doing a bit more mean reversion. So there's always a two type of traders that you trading methods that you can actually employ when you're looking at the market. Now, so I think the first thing is that when you are a trend trader, you need to understand whether the market is it trending or not. If it's trending, is it an uptrend, downtrend, or a sideways market? So the important thing is to identify the trend of the market. And I always say this to a lot of people who ask is that is it a lot of whether quite human nature or not, but there's a lot of a tendency for us, especially when you're looking at a particular trend in the market. Let's say, for example, the market is going on an uptrend. There's always a tendency in us that we try to time the market when the market is going to turn around. We try to pick the top of the market, especially in an uptrend market. I can tell you, if you do this approach, it's a very difficult approach. If you are profitable, I would say, well, you are considered very well versed with the market. But in a lot of instances, a lot of cases I see is that if you try to pinpoint a particular turnaround in the market, a particular top in the market, especially in a trendy market, it's a very difficult proposition. And most of the time, you'll be losing rather than gaining. So therefore, I think if the market is showing you an uptrend market, just have a view or just try to find position or execute strategy that allows you to long the market, especially in the uptrend market, instead of finding points where or execute orders or price level where you think the market is going to turn. By doing that, I can tell you expose yourself to too much of a risk, and sometimes the risk and reward is not worth it. So I think it's important for us to take note if you are looking to to become or rather to employ trend trading strategy. Keep that in mind. So I think one of the key things is that once trend is being identified is to use Heiken Ashi. I think Heiken Ashi is one type of Japanese candlesticks. If you look at it, the calculations is very similar to the Japanese candlesticks, just that it has a little bit of peculiarity, which I think if you're a trend trader, you like it because again, keep it simple, and that's the key. So I think Heiken Ashi simplified a lot of the Japanese candlesticks interpretation, in a sense that it gives you an easier understanding or easier identification of the particular trend at that of the market at that point in time. So in a way, it's easier. Now, obviously, if you are a trend trader, you need to understand whether the trend can continue. So by doing that, you incorporate another indicator called ADX, and because Heiken Ashi is just a tool for you to identify the trend itself. If you incorporate moving averages, it helps you, or in a way, it makes a better decision for you when it comes to identifying point for you to enter and exit. Now, like I always mentioned earlier, there's no point finding the exact entry and exit without managing your risk level. So I think the third indicator, which I tend to always use whenever I talk about managing risk, is using the average true range. Again, this is an important tool. I'm not going to. I like to highlight this because at a lot of times or a lot of point in times that a lot of traders will tend to only emphasize when they should be getting in, when they should be getting out, but they don't have a proper way of managing their risk. So when markets become more volatile, they get a bit frazzled because their stop loss management will get bigger and whatnot. So I think it's important for us to have a predetermined exit level or predetermined risk management whenever you're entering a particular market. So now these are some examples of trend trading indicators. So Heiken Ashi candles are considered trend trading indicators. ADX, average directional, is considered one of a trend trading indicator. moving averages, and MACD, obviously. Now, mean reversion is more applicable in a sideways market. So if you are someone that, if you identify the market in sideways, you like to trade the market in I would say in a predetermined set of resistance and support level, then mean reversion could be a very good indicator strategy that you can use. Some of the mean reversion indicators could be your RSI. So RSI, there's always two boundaries. One is the oversold, overbought levels. So when a lot of traders will always think that, market is overbought, time for me to be out of the market, or the market is oversold, time to me to be jumping into the market. Keep in mind, when you talk about mean reversion, market can go for sideways for a period of time, but once the market go on a breakout phase, that's where a lot of mean reversion indicators tend to fail. So I think that's important for us to keep in mind. So if you are thinking to use mean reversion indicators, you must understand that these indicators works well as long as the market is in the side range market. The moment the market breaks from the side range market, it goes into a rally, whether it's on the upside or downside, that's where these indicators will fail you. So keep that in mind. Bollinger Bands are also one type of mean reversion indicators. Regression channels. Now, regression channels, I know a lot of people tend to use it, but point to caution is that we are putting assumption where, when there's always extreme movement in price, but over time, the key thing is over time, that these extreme movements will always come back to its average. The keyword is time. It's a matter of when. So, for example, if you see the extreme movement in whether it's CPO market, the 8,000 ringgit per ton, do you think it will come back again? It possibly could, but it's a matter of time. So that's where we really need to be careful. Given time, market will tend to mean revert. But the problem with us is that whether in the futures market, we don't have the luxury of time. In fact, every contract has an expiry. So that's where there's an important distinction for us to use a lot of these mean reversion indicators. Stochastic is another type of mean reversion indicators that usually people use, especially when looking at the side range or range markets. So I'm just going to share you this chart. If you just look at it, point A and point B, okay? This is what we call a downtrend market and an uptrend market. So at these instances, a lot of people will be using trend indicators. So at point A and point B, you'll be looking at, point A clearly shows you at that period of time is looking at the chart itself is pointing in possible downtrend. So at these instances, you should be looking at opportunity for you to short the market. Point B, on the other hand, shows you pretty much the market is on an uptrend. So at this point in time, usually you'll be finding opportunity for you to long the market. Now, if you just look at C itself, we look at the market itself, assuming that we are at that point in time in the market, it has quite a pretty nice set of resistance, top resistance. By the way, this is on the CPO market. So the top resistance was about 4,005, and it's actually a very nice support. It bounced above the support each time when it's tried to test the support, which is about 4,001. So when you have this kind of range market, that's where those are mean reversion indicators and strategies will tend to benefit. But keep in mind, like I always say this, the market once it breaks the upper resistance or the lower support, it tends to move quite wild. So that's where when you're using mean reversion indicators, you have to be careful. Now, I think one of the ways is that we always try to identify trend visually. That's the first thing we do. So a lot of people will say, when we look at the chart from left to right, is it going higher or lower? If it's going higher, that means clearly the market is on an uptrend. If it's going lower, clearly the market is on a downtrend. So that's looking at the chart visually. Or as what Dow theory mentioned, is that if the lows of the chart is getting lower and the highs is getting lower, so clearly that is downtrend. As what you can see here, the lows are making lower lows, and the highs are also making lower highs. So in this clear example, what we have here is actually a downtrend market. If it's uptrend market, it's the other way around. So in uptrend market, you always see a higher highs and higher lows. And that's, if you look from the chart from left to right, you can clearly see it's actually going up. So that's what we see clearly is an uptrend market. So one way of looking at the trend market is looking at it visually. Now, sometimes you can interpret the trend of the market. Now, I'm just giving you a bit of options on how to see the bigger picture of the overall trend of market. One of it is usually the scanning is you can obviously just push in the moving averages, and from there we try to interpret where the market is going to go, whether it's higher or lower. So one of the ways is that plotting a 200 days or 200 period EMA together with 50 period EMA. So that's sufficiently long. If you put it on a daily time frame, that means you're talking about 200 trading days against 50 trading days. That's considered, you're looking at 2 months to against 6 months period. That's a long time. So if those candles are breaking below these moving averages, it tells you the market is actually going on the downtrend. Vice versa, if the market is the candles are breaking above these moving averages, that's where the market is showing you there's a sign of strength is going to go higher. And again, that's also what industry or rather market is always look at, the 200 and the 50 period EMA as what we call the golden cross or the death cross. So importantly, I think visually we can see the trend of the market. We can also use moving averages. So as long as the market or rather the candles are trading above these two moving averages, is showing you that market is going on an uptrend. And if the market is trading below these moving averages, it's showing you that the market is actually on a downtrend. So that's one way to distinct the market, whether it's on an uptrend or downtrend market. Now, moving averages is also unique in the sense that it's giving you a bit of in a way of resistance and support level. So imagine this: if the candle starts to break below your 50 period EMA and again your 200 period EMA, that shows you the market is actually on gradual downtrend. So you don't have to wait for the death cross or the golden cross. You just have to look at the candles. Where is it located? Whether it's above or below the candles, and the line itself, the moving averages line itself, is actually providing you the resistance and support level itself in a very dynamic way. So that's how we interpret using moving averages when you look at whether the market is doing on uptrend or downtrend basis. So I think the previous example was on CPO. This is showing you an example of using a 50 period and a 200 period EMA on an FKLI market. So basically, I think you can clearly see that, this is just taken probably today. You can clearly see the market has actually been trading below the 200 and the 50 period EMA for quite a long time. It tried to challenge the 50 period EMA for I think a couple of sessions, but I couldn't break it. And if you just look at it, I think the 50 period EMA is sitting on the resistance line at about 1450. So if FKLI doesn't break the 1450, technically the market is still possibly heading down south. So that's how we look at using the moving averages as a way to determine the trend. So just to show you these two charts as a classic example, if I show the audience these two charts, and if you are a trend trader, just by looking at these two charts itself, which chart will you prefer to trade? Is it chart A or chart B? Maybe I just get some responses for our audience, just so that I just get an idea on are you able to get it as far? Okay, I can see some responses coming in. I think majority of the responses do select chart B, although some responses do select chart A. Now, the difference between both charts are on a similar product. It's on the same product, same time frame. The only difference is that chart A is actually using Japanese candlesticks, which we are all well familiar with. Now, the chart B itself looks slightly different in a sense that because chart B is actually using Heiken Ashi Candles. So if you are a trend trader, you want to identify the trend of the particular market at that point in time. Heiken Ashi is actually a very useful tool in a sense that if you compare to chart A, you get a lot of whipsaws. You never know when you should be exiting the market, when you should be shorting the market, when it's not that clear. If you look at chart B, if you use Heiken Ashi Candles, as long as the candles are telling you that if it's red candles, it's time for you to sell. If it's green candle, it's time for you to long the market. As simple as that. Obviously, there's a bit of rules that you can apply to that. But then again, I think Heiken Ashi can tell you that it makes the distinction between Japan's the trend of the market in a much easier fashion. If you just look at chart A, if I tell you what's the trend of the market, you can't really identify because the market seems to be going on a sideways. Although there's a bit of period of ups and downs, but it looks like generally, if you look at overall picture, it looks like the market is on the sideways. But if chart B, you can clearly see the market is actually pointing towards downtrend on the market. Now, if you are someone that's been trading the market using Japanese candlesticks, you probably be well comfortable with a lot of configuration that the Japanese candlesticks offer. If you read the classic Japanese candlestick handbook by Steve Nielsen, you probably notice that in that handbook it has a lot of 100 different configuration of Japanese candlesticks that you can get. What I have here is just a sample. Doesn't even consist all the 100. So it goes to tells you is that when you are trading Japanese candlesticks, there's a lot of patterns or configurations that you need to memorize and need to understand. Obviously, you can do this comes with experience. If you look at charts often enough and more times enough, you probably will notice that certain patterns in a quite easier and faster fashion. But then again, obviously, if you are someone that's not familiar with Japanese candlesticks, it may take some time. And that's where it gets a bit more complicated. So just to give you a bit of a background for Japanese candlesticks for those who are new. So as simple as that, I think, Japanese candlesticks is a very good representation of price. It tells you the high, low, close, and open, the 4 important data that you need when you want to look at a particular price action for a period of time. So I think Japanese candlesticks tells you that 4 important details in a very great fashion. So this is how you see normal Japanese candlesticks. Your bullish candle will always have a higher close compared to the open. Bearish candle will always tells you the close is lower than the open. And the wicks, which is the upper wick and the lower wick, always tells you where's the high of the particular period and where's the low of the particular period. As simple as that. So these 4 important major key component price will helps you to draw up a Japanese candle. Now, so identifying Japanese candlesticks takes a bit of art. Some people may interpret certain configuration differently. Some may say, oh, this is a dragonfly doji, or this is a greystone doji, or this could be a 3 white soldier or 3 black crow, that kind of thing. Now, Japanese candlesticks, again, it comes to experience. The more time you practice it, the more time probably you get a bit more accurate. If you are someone new to the market, Japanese candlestick can be very challenging in the sense that you need to identify the configuration, and certain configuration the probability may not be that high. So for example, if you see a doji, it tells you there's an indecision in the market, and it tells you there's a possibility that the market may turn. But goes with any type of other doji, the probability of it turning is actually very low. So again, it all comes to experience. So I think I would say, using Japanese candlesticks, it requires a lot of effort. It requires a lot of time. And in a sense that it can be complicated because, again, it's a matter of interpretation. Some may see that this is doji, some may not. And between the doji perspective, there's a lot of different types of doji as well, depending on where the doji is being located at a particular point in the market or particular area in the trend. So it opens up a lot of area of interpretation, and that's where it can complicate things. So to make it easier, I think that's where a lot of people actually go into Heiken Ashi, which is another style of Japanese candlesticks, in a sense that it actually consider more of the average bar rather than taking the whole bar. I think that's why if you look at it, the Heiken Ashi is a Japanese word. Heiken means average, while Ashi means the foot or the bar itself. Same with Japanese candlesticks, there's also 3 types of bars, but it's actually more simplified in the sense that these 3 are the only bars that you need to consider when you look at Heiken Ashi. One is basically the red bar and the green bar, and obviously there's a doji-like candle. And these 3 would pretty much determine pretty much will set up whatever strategy that you need to execute, and it tells you a lot about the trend. Now, again, I think I would say the best benefit of using Heiken Ashi is that you really don't have to really memorize all the 100 different configurations of Japanese candlesticks. You just have to concentrate on the participants' sentiment, or rather the market sentiment. If the market is showing you very strong green bars on Heiken Ashi, it tells you the market has more room to go on the upside. Same goes if the market is showing you red Heiken Ashi, that tells you the market is actually going on a downtrend. So it's as simple as that. The candle color and body length are reliable barometers. So if you have a very big green candles, that tells you the market momentum on the upside is still there. Same goes if you see a very big red candles. So importantly, it's a matter of size. We're looking at Heiken Ashi is the length of the body candle, and also whether there's a wick, whether it's upper wick or lower wick. That will tell you whether the sentiment of the market, is it still there or has it been changing? Now, doji, it works in the Japanese candlesticks, same interpretation. When you see a doji in Heiken Ashi, it tells you the market is actually being very indecisive. The market is, if you are sunny on the uptrend, you start to see dojis, that usually be a point in time where the market is telling you probably the uptrend has actually is starting to feel exhausted, and that's where it starts to go. It may start to tell you that uptrend has lost its momentum. Now, again, I think the key thing about interpreting Heiken Ashi is always the body of the candle. The wider the body of the candle, that tells you the market has strength. If the body is getting smaller, that means the momentum is getting weaker. So that's why you need to be careful. Obviously, you can use that to confirm with other indicators, which we'll talk about later. And I think because of the visual of it, it makes it easier. So if suddenly you see green, if you look at it, there's a series of green candles, and suddenly the next candle is a red candle, that's where you need to be careful, because that also tells you that probably the market is actually starting to change when it comes to trend. So these are the classic examples. So if you see, strong, the first diagram, which shows you red and green candles with upper and lower wick, usually that tells you the strength of the market or the strength of the trend is actually getting weaker. Now, if you see a normal candle with only an upper wick for a green candle, that tells you the market has strength on the uptrend. Same goes if it's on the red candle bar. Now, the third type is the doji type, which I mentioned earlier. The doji type is a bit interesting in the sense that it's not necessarily telling you the trend is going to reverse, but it tells you the trend is taking a pause. It could signal that the market is going into a sideways market. So by that time, you can probably use a different type of strategy. If the market is going to a sideways market, you probably can use a mean reversion type of strategy to trade in those type of market conditions. Now, I'm not going to go too much on how to calculate Heiken Ashi, because like I mentioned earlier, there's a lot of resources. In fact, there's no need for us to understand the calculation, because all it takes is that with a click of mouse, you can probably change your chart layout from Japanese candlesticks to Heiken Ashi at an instance, and from there you get interpretation. So going too detailed on the calculation may not be necessary, but to understand how the Heiken Ashi is being derived is good for us to understand how it's being calculated. So if you look at it, the bar takes is that it still take the four major key price, the open, high, low, and close, but just take the average of it. So that's why Heiken Ashi means it's an average bar. And therefore, if you look at a trend, for a trend to continue, you need successful higher bars. So therefore, Heiken Ashi will always show you green candles. Vice versa, if you look at a trend that's going downtrend, you need successive red candle bars, which tells you that the market is heading lower. So that's how Heiken Ashi interpret the green and red candles. Now, here is actually taken from, I think this is a common general rule if you are using Heiken Ashi. Again, this doesn't apply to all markets, also apply to different market conditions. Importantly, you always have to fine-tune and backtest your specific strategy. But you can always use this as a general benchmark. So if you look at it, if you have a sequence of green body candles in a Heiken Ashi, that generally tells you the market is actually heading on an uptrend. If you see a series of red body candles, that tells you the market is actually on a downtrend. Now, the uptrend will get stronger with longer green bodies. Same goes for the downtrend to get stronger. That means the red body candles are getting longer. So when you see a long body bars, that tells you market generally has momentum and strength. And usually if there's no shadows, it's just a body itself, that usually is a good indication that the trend probably has started or the trend is in place. Now, importantly, we need to notice is that if you are already in the market, you are riding on a trend, we need to understand when the trend gets weaker. Now, based on Heiken Ashi, the trend gets weaker with smaller bodies. So if you see large green body bars and these bodies are getting smaller and smaller, that's where we need to be careful. It tells you the momentum of the uptrend starts to weaken. And that's where we have to pay close attention. If you're riding on the uptrend, we have to probably watch the market a bit closer whenever the body of the candles are getting smaller, especially in the uptrend market. So same scenario applies if it's a downtrend market as well. Now, I think the fourth rule applies in the sense that a consolidation is usually reviewed when smaller bodies start to emerge, especially like doji type. You have an upward and lower wick. In that instances, same goes like Japanese candlesticks is a doji type of candles. It tells you there's indecision. And generally that markets, tells you what it usually tells you that the trend is taking a pause, is exhausted. The market might change trend. The word is might, and that's where you need to be. Probably there's a good time if you are entering the trend. It's a good time for you to be out of the trend of the market. Now, obviously, if you start to see a sudden change in the colored bars, like if I show you a successive 5 red body candle bars, and suddenly there's a green color small body candle bars start to appear. That tells you probably there's a time that the market may be starting to bottom, and that's usually a very good indication that for you to really observe the trend, whether is it going to be a change of trend or whether the market is going to be on the sideways for a period of time. So I think Heiken Ashi itself, with the 3 simple type of patterns that you need to be noted of, it's actually very easy for you to identify a particular trend at the of the market at that point in time. So just to share with you a simple dynamics of applying Heiken Ashi on the CPO market. So you can clearly see, as long as you see green body, long green body bars, that tells you the uptrend in the market is still quite intact. The only concern is that when you approach or when the green body bars or the red body bar starts to appear, especially in a green uptrend market. So that tells you generally, the market is probably going to be on a sideways for a period of time, or that's signaling you that the uptrend that is seen in the previous rally may actually be exhausting at this point in time. So if the red color body bar starts to get wider, that tells you generally the market is on the downtrend. So these are all the dynamics they need to know, especially when you're using Heiken Ashi. And if you see this section of the market here, where you start to see very small body candle, but very long wicks, or we call it shadows. So in the sense that at this point in time, the market is actually very indecisive. It's not sure whether the market is going to hit higher or lower. So it's going to be a side range market. So at this point in time, again, I mentioned you can use different type of strategy when you look at this type of market, because the market is not going to hit anywhere. So mean reverting strategy will be quite a good opportunity when you look at this type of market. So in a classic example, you can clearly see Heiken actually helps you to identify at which period of time the market is trending, whether it's on the upside or downside, and at which period of the market that's actually going into the sideways market. So that's on SCPO. You look at FKY, again, also you can clearly see some examples, some of the dynamics of Heiken Ashi. And you look at it, I think FKY has a bit more on the downside, because the body of the red Heiken Ashi bars are actually quite wide. So it tells you that downtrend momentum is actually quite aggressive. So in a sense that it actually gives you a better picture on whether the market is on uptrend or downtrend basis. So if you use a normal candlesticks chart, it's actually very difficult for you to identify the trend at that point in time. But if you use Heiken Ashi, in a sense that it's simplified for you, because it's taking the averages of it, and it shows you in a colored bar. So as long as you see green and red body bars, this pretty tells you whether the market is on an uptrend or downtrend. Now, one key distinction of whenever you use Heiken Ashi is that, Heiken Ashi tend to close up gaps. They don't show you any gaps at all. What I show you here is same product, same time frame, but one is on candlesticks and one is on Heiken Ashi. So obviously the chart on the left is normal Japanese candlesticks. You can see there's gaps. So if you are someone that's trading based on gap analysis, you can't use Heiken Ashi because Heiken Ashi doesn't show you the gap. In fact, it represents the gap by a colored body bar. So you can clearly see these gaps are gap lower. It's a lower gap down. And those gap lower are actually represented by long red body bar. So in the sense that the market is still generally on a downtrend. So if you're hoping to use gap analysis, Heiken Ashi can't show you much information on that. So that's a very important decision you need to make whenever you use Heiken Ashi. Now, I think this will show you a better distinction between the normal Japanese candlesticks and Heiken Ashi. You tend to notice is that, Japanese candlesticks, sometimes you see a doji, you always interpret, oh, there's probably a change in trend. If you look at Heiken Ashi, if you close it up with Heiken Ashi, you probably will notice that, there's no dot. If you look at doji, it's indecisive, but at that instances, Heiken Ashi tend to show you that there's a bit more trend continuation. So same goes for whenever you have a gap in the market. So in a sense that, if you want to stay longer in the trend, Heiken Ashi is actually more suitable as compared to only using Japanese candlesticks. So I think that's one of the ways, if you are a trend trader, you want to use Heiken Ashi as a tool. It helps you to stay longer in a particular trend, rather than using Japanese candlesticks where sometimes it gives you very indecisive signals. If you see doji in an uptrend market, you get a bit more pressure because you're not sure whether the uptrend is facing exhaustion or whether the uptrend is going to continue. So that's where I think Heiken Ashi will help to simplify that a little bit. Now, these are the major differences. I think Heiken Ashi, you only take the three major forms that I just mentioned earlier. It's very quantitative. It's actually based on the average of your normal Japanese candlesticks. This is a calculation that all matters. And in a way that, it helps in the sense that if you are looking at trend trading or trend flowing methods, Heiken Ashi does assist in that. And in all matters, it's just the color of the bar. Red and green will tell you pretty much the trend of the market at that point in time. Now, Japanese candlesticks, it's actually a very useful tool, but it takes a lot of practice. It takes a lot of time. So if you are someone new, really Japanese candlesticks needs a lot of time to brush up. It's very subjective in nature. Like I mentioned earlier, there's a matter of interpretation of the people interpret it. So some people may interpret this as a different configuration as to other people. And I think if you look at most Japanese candlesticks that's out there, the configuration of it is actually more related to reversal patterns. So if you're a trend trader, you're more inclined to choose indicators that's actually telling you the trend can continue or to be in the trend. Japanese candlesticks, if you use that, it tends to tell you when there's a turn in the market or when the weakening in the trend persists or when the weakening in trend happens. So it's more of a reversal patterns. And obviously there's a lot of pattern identification. So it's really it's the nick of the eye, whether are you able to see it or not, and are you able to recognize those patterns. Now, being as it is, I think Heiken Ashi do come with a few disadvantages. I think because of the way that it smooth out the price movement, in certain ways it tends to be a bit more lag. It's like how moving averages works, because it tends to it discounts a lot of past data, so it tends to smooth out the data. So in a sense, there's actually a bit of a lag. You can't always beat price action. Price action always is what you get instantly, but using indicators like this, it tends to be a bit more lag. Now, if you want to base on Heiken Ashi candles and just look at it and base those data like the opening, high, low, and close, it gives you a different picture and gives you a different set of prices as compared to Japanese candlesticks. So that's why you need to make the distinction. So, for example, the close that's shown on Heiken Ashi is not the same close as if you talk about the same bar on the Japanese candlesticks because of the calculation of it. That's one important distinction we need to make. Again, I think we always talk about there's no gaps in Heiken Ashi because it actually include the gaps as a bar. So that's where if you talk about gap analysis, this gets a bit more complicated. Now, I think other than that, if you talk about you need to see better patterns, how the price behave in a more nuanced fashion. I think importantly, I think Heiken Ashi may not show that because Heiken Ashi only matters is whether the trend is there or is in place or the trend is exhausted. That's as simple as that. It doesn't tell you much more than that. So I think importantly, we need to make that distinction. So if you want to study the further how the particular price has been formed at that point in time, you really have to mix it up with Japanese candlesticks or any type of other trading strategy that you have in mind. Just to show you, the difference between Heiken Ashi and Japanese candlesticks, here you can clearly see this is a closing price, for a particular bit on the Japanese candlesticks. And if you just look at Heiken Ashi, the close price is actually different. So when you make the important distinction, you need to make sure that when you reference the closing price, it's actually a different price altogether. Now I would say when Heiken Ashi, when you look at Heiken Ashi as itself, doesn't always say that it tells you where the trend is going up or down. In a sense that Heiken Ashi can also, it looks like Japanese candlesticks in a sense that it also tells you the chart pattern. So clearly you can clearly see it shows you a head and shoulder pattern on the SCPO market, and you can clearly draw a neckline on that. And once you break that, that tells you the market is actually heading on a downtrend. So it works in the same ways when it comes to identifying chart formation and chart pattern, like how you interpret the Japanese candlesticks. But the only thing is that you really took out the gaps in prices, so it doesn't give you the kind of deeper analysis. So moving on to that, I think that's on Heiken Ashi. Like I mentioned earlier, relying on one indicator may not be sufficient. It's always good to have another indicator, with you in order for us to actually better interpret the market. So I think one indicator is what we call the ADX indicator. I think ADX is basically, you have always a plus. It's what we call directional indicator. We have always a plus directional indicator and the minus directional indicator. Actually, it's all derived from the differences between taking the lows, comparing the lows of today's lows against the previous low, comparing today's high against the previous high, and just take the difference of it and we add it up all together. So this is what we call DMI, a directional movement indicator. So I don't go too deep on the calculation of it, but what is important is that the ADX is actually a smooth average of both the plus DI and the minus DI. So whenever the ADX gives you a reading of, let's say, above 25, this is what market convention is. That tells you market is actually quite trending. It could be trending on the upside, it could be trending on the downside. So that's important for us to distinguish. Anything that's below 25 or in fact below 20, that tells you market is actually on a sideways market. There's not much of a action on the upside or downside. So at this point in time, you could be using or you could be looking at a stochastic or even RSI to better gauge if the market is moving on a sideways market. Now, this is basically the configuration of how you get the plus DI and the minus DI. I'm going to go too much or too details in it. Basically, it's actually comparing the high, today's high and the previous high, today's low and the previous low. As long as you get a difference, you just add it up and basically derive the indicator. Again, there's no point for us to go too details on the derivation of such an indicator. It helps you in the understanding of it. But I think with modern conventional chart tools that you have, these are all being added. So it's just a click of mouse, you probably will get all these tools being interpreted for you. Now, I think to show you how to use the ADX. So if you just look at the bottom panel, again, this is on CPO chart. You notice that the point 20, ADX 20 points is basically tells you anything below the 20 points, generally it tells you market is actually on a sideways market. Now, anything that's above the 20 points on the ADX index, it tells you the market is actually trending. You can clearly see, I think back in early 2022, just before the Ukraine and Russia conflict, you can clearly see the ADX actually starting to move higher. And really, I think once CPO break the 5,000 psychological resistance, I think that's where the market go berserk. And you can see the ADX level actually trend higher. Now, when ADX starts to lose strength, same goes for any index. It tells you that whatever trend in the market is starting to show you weakness. So if the index point starts to decrease, that tells you if you're in an uptrend market, it's time for you to be really exiting the market, because the market trend has probably changed or the trend itself has exhausted. So again, the important thing to distinguish is that this ADX works, the way to interpret it, as long as above 20 or 25, that tells you the market journey has been trending. It can be up, it can be on an uptrend or a downtrend market. So on the downtrend market, if the ADX value is going above 20 or 25, that tells you the downtrend is having a bit of momentum and the strength on the downside. So that's why you should be finding opportunity for you to short the market. Now, besides, if you incorporate both the plus DMI, plus DI and the minus DI, actually there's also a way to interpret it. If you just look at the blue and the orange line, the blue line is basically your plus DI, your orange line is actually your minus DI. Whenever there's a crossover, that tells you the market is actually going to trend higher. The black line is actually your ADX line, which I showed you earlier. So as long as the market is going on an uptrend, there's a crisscross for the positive DI crossing above the minus DI, that tells you the market is generally going to uptrend. Vice versa, downtrend market, you can clearly see the minus DI is actually crossing below, or no, crossing above the positive DI. That tells you generally the market is on the downtrend. And true enough, you look at ADX, it's actually trending higher as well. So these all coincide that it's a very good indication the market is going to hit downtrend market, and the momentum of it is going to be strong because of the higher ADX value. So that's how you use ADX to also identify the strength of the trend whenever you look at the trend of the market. Now, divergence also works equally as well. You can interpret divergences using an ADX indicator. So again, you can clearly see the higher highs on the DM minus DMI is actually getting lower. And you just look at the market itself, the high highs doesn't seem to breach the previous high. In fact, it's quite flat. That tells you pretty much there's a negative divergence in place. So that's one way of interpreting divergences using ADX indicator as a tool for us to gauge the market strength. Now, I think thirdly, I will talk about moving averages. So there's a lot of type of moving averages, starting off with the simple moving average and the exponential moving average. Now, simple moving average is basically taking, let's say if you're talking about 5-period SMA, you're just taking 5 daily prices of the particular day, closing prices, and you just divide it by 5. That's simple. Now, there's also other type of moving averages that's available. I think the one that's mostly and widely used is the exponential, because simple moving averages tend to drop off the earliest data. So it tends to a bit more biased in a sense. So if you use exponential, it based on weight. So the most recent data will be given more weight. The previous data will be given less weight. So in a way that incorporates all the data, it doesn't drop off any data. So in a sense, the exponential moving average, in a way, because of giving more weight to recent data, it tends to react to the market in a much faster fashion as compared to just relying on the previous data. So in a sense, that EMA does move faster compared to SMA. And I think moving average, in the sense that I've shown you earlier, you can use that to identify the trend in the market, whether the candles are trading above or below. So it gives you a good sense to as to how the market is trending upwards or downwards. This is to show you a classic example comparing simple moving averages and the exponential. You can clearly see, if you look at it, exponential reacts to the market in a much faster manner as compared to just looking at simple moving averages. So the classic distinction, the basic distinction is that exponential tends to react to the market in a faster manner as compared to simple moving averages. So how do we incorporate moving averages with Heiken Ashi? As simple as doing a crossover. So you have a bearish crossover and a bullish crossover. So how do we get a crossovers? To get a crossover is simple. We're just comparing two periods of different EMA lines. One will be the shorter term and one will be a longer term. So in this example, I'm using a 9-period EMA against a 20-period EMA. So the 9 period is considered a shorter term because it's only considered 9 time period. The 20 period is considered a longer term because it's considered 20 time period. So whenever you see a 9 period crossing below the 20 period, that tells you market is on a bearish crossover on the moving averages. And if vice versa, if 9 period crossing above, it's actually a bullish crossover on the EMAs. So how do we incorporate with Heiken Ashi? So if you see a Heiken Ashi bars and starting to break below both the moving averages, and you see a bearish crossover on the moving averages, it gives you quite a good signal that the market is generally going to be a downtrend market. So that gives you a high probability of execution a short position at that point in time. So obviously, vice versa, if you see a green candle and the candles are trading above the moving averages, and the averages are showing you a bullish crossover, that's where normally is a good point of execution, a long strategy, or if you're already shorted the market, it's a good time for you to be exiting the market because the trend on the market probably will be changing pretty soon. So another example, this based on the CPO market. So you see a red Heiken Ashi bars which penetrate both the moving averages line, and in fact there's a crossover on the moving averages, which is a bullish crossover. It shows you quite a good example for you to pretty much execute a long position in this point in time. So now, just to give you a dynamic of interpreting Heiken Ashi with moving averages line. So at this point in time that I show you here, you see a green Heiken Ashi bars, and you see the shorter term EMAs, the 9-period EMA crossing above, which is considered as bullish crossover on your moving averages. What will you do? So at this point in time, you probably will be thinking of taking a long or execute a long position, and that's how you probably will be riding the trend of the particular market at that point in time. So obviously, I didn't incorporate ADX. You can also put an ADX. And if ADX shows you any reading that's above 20 or 25, the market is trending. The key thing is about using EMAs together with ADX. ADX can be quite when it shows you the turn in the trend or the turn in the strength of the trend, it can be quite sluggish and it quite lag in certain ways. So if you want a faster signal, it's always good to just incorporate moving averages together with just Heiken Ashi for you to get a better gauge. So in this sense, you see the market. There's a green Heiken Ashi bars. There's a bullish crossover. It's a quite good signal for you to take a long strategy at this point in time. So example of short strategy is where you see a red Heiken Ashi bars and there's a bearish crossover on your moving averages, and that will be a very good position for you to short the market. Okay, so last but not least, I think the last indicator I will mention for tonight is the average true range, which is what we call the true range indicator. So I'm going to go through details on the calculation of it. You can obviously get this on the net. Again, I think nowadays with modern tools, you just click a button, you can get ATR indicator calculated at the instance. So what this ATR indicator really measures is talking about volatility in price. So as long as ATR increases, that means the volatility of the prices or the price traded in the time frame itself has actually increased. So you can clearly see this ATR value based on a daily time frame on CPO actually increased back in early 2022. The daily range at that point in time before the outbreak of Ukraine and Russia conflict, it was actually doing about 50 to 150 points a day. I think during the peak of the conflict, we are talking about 450 points a day. That's massive. So if you are putting a stop loss, or rather, or having a stop loss management in place, you're expecting the price on a daily movement to be about 400 points, which is huge. So that's where I think ATR is important for us to measure market volatility. Right now, the ATR value for CPO is about 100 to 150. As of today, I think it's about 120. That means on average, the daily range that we expect the CPO price to move is about 120 points. So that's what we mean by ATR. So it helps you to determine the volatility of the market. If the ATR value is in a very tight range, that tells you market is actually quite sideways. But if the market starts to break on the upside or downside, you probably will notice ATR will start to increase. So that's again quite a good measurement for us to indicate whether the market is actually very volatile or not. So what's this ATR mainly used for? I think ATR is very crucial for us to measure your stop loss level as well as profit target level. So for example, going back into a previous example that I've shown you earlier, there's a sell signal here because of the red Heiken Ashi bars together with the bearish crossover and the moving averages, and we look at the ATR value at that point in time is about 26 points. So how do we calculate the stop loss level? Very simple. If the ATR value is 26 points, if we work on the reward to risk ratio 2:1, that means you are willing to risk 26 points based on the ATR value for a reward of 52 points, 2:1. So that's how you place your stop loss as well as your profit target level. So ATR, in a way, measures, it helps you not to get stop out easily. Trust me, there's a lot of ways for you to set your stop loss level. Some could use monetary value, some could use arbitrary number, some could use support resistance, so be it. But I think ATR is a great tool because whenever the market gets volatile, that's where you tend to see your ATR value extended. If you set a very tight stop loss, especially when market is very volatile, you get stop out easily. So that's why ATR is important for us to make sure that we don't get to stop out that easily when the market gets a bit more volatile. And when markets are very volatile, we make sure that we are out of market with a fair amount of losses that we can incur based on the ATR value. So ATR value in that sense gives you that kind of comfort. So another example is on FKLI. So you start to see there's a sudden change in the colored bar. It used to be green colored bars on Heiken Ashi. It starts to turn to red. So that's quite a good signal for you to take a short position. And also look at it. There's a bearish crossover in the moving averages. That's quite a good signal to go short. And the ATR value is 20 points. So if you work on the again, based on the ATR value of 20, your reward to risk 2:1, that means you're looking at 40 points profit and 20 points stop loss. Importantly, ATR is always used to manage your stop loss rather than focusing on the profit target level. Now, obviously, there's also other factors to consider, which I didn't mention thoroughly in this webinar because given the time limitation. I think importantly, if you're someone new to the market, always understand the market that you're going to trade with. Every market behaves differently. I'm not to say that this strategy fits for all market. You have to really backtest it, fine-tune whatever strategy that you have in place to make it fit to your market that you're trading. I also didn't mention position sizing. Position sizing is a very important tool. In fact, I think it is a very critical element for a new trader to really understand position sizing because it matters. If you size too much, too early in the market trend, and in the market suddenly take a turn, you get caught very fast. So position sizing is very critical. Entries, when to buy and sell, hopefully using Heiken Ashi will give you a clear indication. Stops are important for us to manage our loss. Now, exits are also equally important. I know everyone is very concerned of, I want to make sure I hit the profit target level or with the minimum stop loss or whatnot. I think the way of exiting a particular market is equally as important as rewarding yourself in a particular market. So I think ATR is a very good strategy for you to manage your risk. And if you want to talk about when to enter and when to exit, I think ATR helps you in a way that to manage your stop loss level. Tactics, I think there's a lot of tactics that you can use. And that again, depending on what trading styles are you going to be using. Are you more of a intraday trader? Are you more of a trend swing trading? Or are you more of a position trader? Last but not least, which I didn't cover much also is I think if you are trading on a full-time basis, the result of profit and loss is just a result at the end of the day. Importantly, I think the mental process, the mental thought that you go through it, that's also very important. That's why a lot of successful traders, they do a lot of journaling. And I think it's a very good that if you are someone new, start off with always a good trading journal that keeps you up to track what are your thought process that's being involved, especially when you're making those critical decisions during the particular trading time. Just a recap, I think on trading strategy, I think first thing is to identify the overall trend of the market, whether you're looking at it visually or whether you're using moving averages to determine the trend of the market. And I think secondly is to look at gauging the market trend with Heiken Ashi candles. I think Heiken Ashi itself is a very good tool if you're looking at trend of the market. Again, it feels in a sense that if you're looking at depth strategies, or you're looking at identifying or going more, you need more details on the formation of particular prices. Heiken Ashi may not provide you that much. So that's a very clear distinction you need to make. Now, obviously, Heiken Ashi itself is in a way may not be accurate enough. You can always use moving averages to make sure that you have a better success rate. So this one I shared with you on using the moving averages as a crossovers, and obviously you can look at the strength of the strength using an ADX indicator, and last but not least, manage your risk using an average true range indicator. So I'm just going to end this with this quote. I think it's quite encapsulate the whole trading journey. So what this quote says that what most people don't get about trading is that it's a performance activity. That means it takes skills, craft, acumen, and intuitive. It's basically like any sports, and it's really an art. It's actually not really a science. You cannot just learn it from book or YouTube video. You need to experience it, the whole journey, and really, I think, be passionate about it. I think it's between you and your spirit also. It really requires you to be fully immersed into the trading journey, and definitely it's not an easy journey. A lot of people will be thinking that trading is always an easy journey, but it's not. So those who try to sell you the dream won't tell you that. They always tell you that it's always easy, but those who live the dream, they won't. Some in fact they won't tell you, but you know who are they. So with that, I think I'm just going to end here. I'm just going to pass it to CY for any Q&A.